Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tencent Music Entertainment Group latest report. Tencent Music Entertainment Group provides a wide range of businesses and services to cater to the diverse needs of its users. At the core of its offerings are music streaming services through QQ Music, Qgu Music, Qwo Music, and WeSing, which enable users to discover, enjoy, and share music in personalized ways. In addition to music streaming, the company offers long-form audio content such as audiobooks, podcasts, and talk shows. It also provides music-oriented video content, including music videos, live performances, and short videos. Users can sing along with karaoke songs on WeSing and share their performances with friends. The company's music-centric live streaming services are delivered primarily through the live streaming tab on its various platforms, providing an interactive online stage for performers and users to showcase their talent and engage with audience bases. Lazy Audio is another audio platform offered by Tencent Music Entertainment Group. Tencent Music Entertainment Group also sells artist-related merchandise such as branded apparel, posters, art prints, and accessories. It offers other music services including content licensing, sales of digital albums, customized artist-related merchandises, live performances and concerts, and artist management services. The company provides music subscriptions and advertising services across its social entertainment platforms. Overall, Tencent Music Entertainment Group's diverse range of businesses and services has established it as a leading player in the online music entertainment industry in China. Tencent Music Entertainment Group market capitalization of 193 billion is significantly larger than the average industry peer of roughly 20 billion. This shows that Tencent Music Entertainment Group holds a significant advantage in their industry. Tencent Music Entertainment Group trades at a higher price-to-earnings ratio of 15 times and a higher price-to-book ratio of 0.94 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price to value than it appears. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The balance sheet appears very conservative, with liabilities representing only 23% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth in the music industry are multifaceted. One key factor is the significant increase in revenues from online music services, which grew by 21.7% year-over-year. This growth can be attributed to several areas, including a 13.2% rise in music subscription revenue and increases in offline performances and advertising services revenue. Another important driver of revenue growth is the expansion of live performances and curated merchandise, which has been accelerating. Additionally, solid growth in subscription services has contributed to overall revenue growth. Furthermore, revenues from online music services have seen a 22.9% increase due to strong growth in music subscription revenues and other areas such as offline performances, advertising services, and artist-related merchandise. In contrast, the primary drivers of revenue decline are limited. While there is no mention of significant declines on page 3, revenues from social entertainment services and others have decreased by 5.2% and 7.3% in different reports. These decreases highlight areas where the industry may need to focus on improvement or diversification to mitigate losses. Net income experienced a significant increase of 53.4% year-over-year, indicating a substantial improvement in the company's financial performance. This growth can be attributed to two key factors: an increase in gross margin and a decrease in operating expenses as a percentage of total revenues. The rise in gross margin from 42.3% to 44.2% suggests that the company has become more efficient in its production or pricing strategies, resulting in higher revenue per unit sold. However, the story is not entirely positive for profit margins. While the gross margin improved, the operating margin likely decreased due to a 6.2% increase in total operating expenses. This indicates that despite the growth in revenue, the company's costs are rising at a faster rate, eating into its profitability. As a result, while net income has increased, the overall profit margins may not have kept pace with this growth. The company's financial performance indicates a consistent generation of positive operating cash flow. The net cash provided by operating activities for the years 2024 and 2025 is RMB 10,231, approximately US$ 1,463, demonstrating a stable trend in generating sufficient funds from its core operations. This suggests that the company has been able to manage its expenses effectively and maintain profitability, ultimately resulting in positive cash flow. The company's financial health has undergone a notable shift in recent times. A significant increase in the company's total debt level is evident, with a substantial rise of 25%. This escalation has seen the company's debt level jump from RMB 55.9 billion to RMB 70.1 billion. Management is optimistic about the company's outlook, citing a strong year with a significant increase in operating profit. Specifically, they highlight a 17.9% year-over-year growth in operating profit, which demonstrates the company's ability to generate revenue and maintain profitability. The driving force behind this success is attributed to the growth of music subscription revenues and the expansion of membership privileges. This indicates that the company has successfully implemented strategies to increase customer engagement and loyalty, leading to increased revenue streams. Furthermore, management notes that the company has a robust cash position, with RMB 38.04 billion, US $5.44 billion, as of December 31, 2022. This strong financial foundation provides a solid base for future growth and investment opportunities, reinforcing the company's positive outlook. The company's financial history reveals a consistent practice of paying dividends to its shareholders. This indicates that the company values its investors and is committed to returning value to them through regular dividend payments. The mention of dividends on pages 3 and 10 specifically highlights this commitment, suggesting a long-standing tradition of prioritizing shareholder returns. That concludes the financial summary for Tencent Music Entertainment Group. Feel free to comment below, and I will be happy to answer them when possible.